Okay, I think we will kick things off. Hi, all, and welcome to our State of the Markets discussion. As you know, I'm Joe Gallemore, Director of Investment Management with Argent Advisors. Today, we are going to discuss 5 questions that likely are, or maybe should be, on the top of investors' minds, given the very interesting year we're having so far. And today, we are fortunate to have with us Karl Krietsch from JPMorgan. Karl is a managing director and senior client advisor with JPMorgan Investment Management. So he is supported by the full brunt and force and brain trust of JPMorgan and their army of analysts. And we at Argent Bridge, we look to him as a thought leader, and he's become a real trusted source for investment insight. So Karl, thank you for joining us today.
Wonderful, wonderful, wonderful comments. Thank you. Happy to be a part of it.
Yeah.
I've known, for those on the call, I've known Diane since 1994. So it's been a pleasure to be working with her that long. So I don't want to date either one of us, but
Wow. Yeah, I don't know.
I was an intern at James Madison University before my senior year, and I worked with her team in '94. So go back a long while.
Amazing.
Yeah.
So Karl was local to Virginia and has now gone big time. So
yeah,
thanks for being here.
I'm in Philadelphia. Don't hold it against me. Don't hold it.
Right. Yeah, we
Still a
won't.
Commanders fan.
So now before we dive in today, I want to take 1 second to provide some context to all our viewers around the things that we're going to talk about today. These topics are going to be about the markets and investing in general. They are not meant for any one specific financial plan, nor are they geared toward anyone's unique situation. I've always thought that weather kind of offers the best analogies for investing. And in this sense, think of it as the weather affects all of us all the time, but in very different ways, completely dependent on where we are and what we're doing. So just keep that in mind as you're listening today. And please feel free to follow up afterward with any questions with myself or with your Argent Bridge advisor. And if you want to submit a question while we are talking, I will monitor that. There's a chat function that everyone should see at the bottom of their window. Go ahead, submit that chat question to me. And if it's general enough, we will bring it up here today. And if not, we'll try and answer it after the call. So Karl, first question that we have for you and for JPMorgan. Now, we often counsel our clients that the stock market is not the economy and vice versa. Can you help us differentiate what is happening in the market right now and what is happening in the economy? Because it seems like both are, clouded with lots of negative headlines, but exactly how much of it is just noise?
Yeah, and I think it's a great starting question. We'll do our best to answer it. Yeah, I think that's the word of the year is uncertainty. There's just a lot of noise out there as we're all trying to figure out what the administration is attempting to do with some of their policies. We started the year pretty optimistic that the new administration, despite what you might have heard on the campaign trail, was actually given a pretty good starting point. And so we had a pretty optimistic outlook for 2025, and then we started to hear some of the policies that the administration put in. So we too are in limbo. I think we are trying to not predict, but just try to make sense of what's out there. And once we get clarity, then I think the market will settle down, because once you get clarity, then you can say, okay, so this is what it means. So then how do I survive or thrive, et cetera. So when we think about the economy, I think what's really picked up, unlike earlier in the year or at the start of the year, is this recession word. Are some of the policies that we're hearing about going to put us into a recession, which at the beginning of the year, we had ultimately almost a 0% likelihood of a recession this year. But even though that risk has gone up, I think we want to take a step back and just say starting points matter, because if you look at the first chart, the first thing we would highlight, so this looks at GDP, a measure of growth here in the States, going back to the first quarter of 2021. And you can see growth has been strong, not just for the past couple quarters, but for years, and for years we've been talking about growth was going to slow back to trend. but it has continued to surprise to the upside. So I don't know now if we'll see another surprise to the upside, but again, we're starting at a very good point of solid, consistent growth in the United States. If you look at the next chart, another starting point that I think bodes well for us largely avoiding a recession is if you look at the labor market is still very healthy. So if you look at this chart, you can see unemployment is still hovering right around 4%, and it stayed at that level. So what it means is people are largely employed, and they're largely employed and they feel good about their jobs. If they're not employed, it's probably due to a skills mismatch or maybe potentially geographic issues. But again, we have a healthy labor market, and wage growth that has come down is settled though at long-term averages, pre-COVID averages. And the other thing that's important is what we're spending money on has come down in price. And we'll touch a lot more on inflation later. But again, so we're employed, we feel good about our jobs, we're making more money, and what we're spending that money on has been coming down since the summer of 22 when we look at inflation. And then the final chart that I would look at just from a standpoint of, the starting point is if you look at the next chart, profits, when we look at the U.S. corporate sector, profits are still healthy. We're expecting to see, you can see on the left here, somewhere between 10 and 14% earnings growth. Even if that's a little high, we're still forecasting, even with some of this noise, companies still being able to generate positive earnings off of pretty successful profit margins. So if we have some clarity and we have real tariff implementation, we have some of the other things that we're hearing about, and we see an erosion in growth. We see, the labor market start to soften, and maybe profits, start to decline. Because we're starting with such a strong point, I think what will happen is it will be more of a traditional run-of-the-mill slowdown as opposed to an out-and-out recession where we have negative GDP growth. So let me just stop there, and then maybe I can pivot to the market side. But let me make sure I didn't miss anything, Joe, as it relates to kind of the economy there.
Yeah, yeah, those are the pillars
Okay.
as we see it.
So when we pivot then to the market, if you look at the next chart, and these are all charts from our Guide to the Markets presentation that we've been doing for north of 12 years that really try to help advisors and the advisors who talk to end clients make sense of all of the noise. This is a measure of the S&P and a valuation measure. And we just use the S&P valuation, but if I looked at almost any asset class, we are near all-time highs. And the markets really starting the year were almost priced for perfection. So when you have that environment, you're really vulnerable to any sort of negative news, whether it be tariffs or something else. So ultimately, right now, the volatility in the equity market, the why has been the tariff threat. But if we didn't have tariffs, if for some reason they didn't go down that path, there would have been something else probably that would have given us some pause and probably would have given us a little bit of a correction. I will say, as painful as this feels as an end investor, if I look at the next chart, I will highlight one small solace in that this is normal. So this is probably the most used chart in our Guide to the Markets. And what it looks at is it really tries to help investors understand what it means to be an equity investor. So this looks at the last 45 years of the S&P 500. The gray bars represent what was that year's total return for the S&P 500. The red dot represents what was that specific year's worst peak to trough drop in the markets, triggered by who knows what. And the tagline is up top, if you can see it, on average, in the equity markets, you should expect to see a drop of close to 15%. That's normal. So we saw, if you look to the far right, year to date, this is through Tuesday's data, we had about a 10% correction. So that's painful, but I would point that this is actually only about 2/3 of what typically happens. And also, you can see that despite that, we're now only down about 2%. So we've already seen the market rebound quite a bit. So the market sold off on the threat of tariffs. It's still uncertain, it's still choppy. But again, whether it was tariffs or something else, this is normal. It's not fun, but this is normal. And I would point you to the last 2 years. We've had unbelievable returns in the equity markets of 24 and 23%. And again, we did those with very little volatility. So again, I think this is something just to put the short-term volatility in the equity markets into perspective. And then I would highlight one more page, and then we can pivot to the next question. This is from our guide to retirement, and I think this is an exceptional one to focus on, because it's not timing the market, it's time in the market. And so what this looks at is going back 20 years, looking at the S&P 500 and the risk of letting emotion, letting short-term volatility impact your long-term investing time horizon and have you get out of the markets because you're uncomfortable. And what it shows you is, if you can see it, over the last 20 years, the S&P, if you stayed fully invested, the S&P was up an annualized 10.4%. If you missed just 10 days out of the last 20 years, you lost 40% of that return. And it's in the box in the chart. It shows you that quite often those awful days are quickly followed by the big days. So again, people might get out before it really goes down another leg, but the problem is they don't get back in. So the big point we want to stress is volatility is normal, whether it's driven by tariffs or something else. We should realize that, and we should not let the short term impact our long-term investing. So let me stop there, Joe, and see if there's any
Yeah.
questions on that.
Oh, that is excellent information. Thank you. And I like the line you included. It's not fun, but it's normal, the
Yeah.
market volatility, and that's what it is to be an equity investor. Super. Now, you mentioned tariffs a couple times in there, and that's obviously one of the biggest buzzwords nowadays. It's certainly been one of the loudest issues in 2025, but I think it's also one of the most confusing. So whether or not tariffs end up being a larger element of policy than they were before this, can you help us shed some light on how tariffs might directly affect clients?
Yeah.
And can they or will they affect our investment strategies?
They will, if implemented, and then you see the reciprocity, they will impact portfolios because but I would say it's not going to be a brush across every company in every sector, because you can see even today there are certain sectors, specifically autos and parts of tech, that are being focused on, but there's other parts of the economy that aren't. So I would say even if we do have tariffs implemented and then reciprocity from our other countries, it will impact portfolios, but not universally. But it is, again, just it's creating uncertainty at the individual level. But think about a company right now who's trying to think about how they use their excess cash, and do they want to do CapEx and build a building? Do they want to hire workers? Do they want to buy back shares? But they don't know, do they need some of that money because everything that they use to make their products is going to cost more. So again, it's sort of creating inertia right now till we get a better picture. But ultimately, tariffs, if implemented, will impact portfolios because it will hurt certain companies, because they will see, a slowdown in revenue growth, and margin compression because elevated costs. I have a chart here showing you inflation, and again, we've had this wonderful, downward trajectory of inflation since the summer of 22, and we're getting to that Fed target of below 3%, which allowed them to start cutting last year. But if we have tariffs and trade wars, it's just going to mean prices go up, because companies are going to pass a lot of that extra cost on to consumers. And so again, I think that's the danger. What we would hope is the threat of tariffs is really to at some point level the trade and the relationships we have with our partners, but also meant to just bring people to the table to reconstruct those agreements. If that's really what they're trying to do, I think we would applaud that. because I think then it wouldn't have these bigger negative impacts down the road. However, I was listening to Bloomberg very early this morning, and one thing that I would highlight, or I stole a line from, was even if we do have, a real tariff battle across our northern and southern partners and neighbors, as well as Europe, as well as China, your investing time horizon is definitely longer than any tariff trade war duration might be. So I would just keep that in perspective. But again, it's something that unfortunately has created a lot of limbo problems for individuals and companies, because it would definitely lead to slowing growth, higher prices, and potentially, certain companies having a tougher time, delivering on, the earnings that we're forecasting.
Right. Thank you. Yeah, I think in the last month, I've heard more about tariffs than I have in the last 40 years.
If you look at the next chart, I mean, this is one we just added. It's
Oh
going
man.
back to the 30s. I mean, what's being proposed right now are tariffs that we haven't seen in almost 100 years. So, but the key word there is it's proposed. So
Right.
again, until we have real clarity, it's unfortunately just creating uncertainty in the markets. But just rest assured that if we did have, real implementation of these, it would largely slow growth. Now, I did mention earlier that I don't think that would lead us into recession potentially, because we're starting at such a good point, but it would
Yeah.
definitely slow growth. It would definitely impact the unemployment or the employment market, because if people are spending less because things are costing more, you might start to see layoffs. So it could impact the economy
Yeah.
if they did go forward with these.
Okay. But they, like everything else, they will find an equilibrium. And like you said, your investing time horizon is typically
You
farther
would
than that
hope.
equilibrium.
And even if they do go forward and some of the negative stuff does happen, ultimately the market just wants certainty. I think back to the fall when we were wondering who was going to win the election. It really is, the market just doesn't really care who. They just want
Yeah.
to know, because
Right.
once you know, now it's dangerous because you can think, or based on what I heard, this is going to happen, and that doesn't always happen. But at least knowing the certainty of whatever it is, I think allows you to then take a step. And,
Right.
I'll give you a great example for those that follow it. So GM a few weeks ago decided to do a pretty significant share buyback with a lot of the cash they had on the balance sheet. And it struck people quite odd, because that's a bold move with such uncertainty about, tariffs, specifically in the auto sector. And you look today where, he wants to move forward with pretty significant tariffs in the auto sector, and GM is down quite a bit. I think because they made a bold call, and without tariffs, maybe that was the right call. But
Yeah.
again, it's, the risk of making decisions based on what you think is going to happen is pretty dangerous, which is why everybody's just in limbo.
Yeah. Yes. Okay, gonna switch gears a little bit to over to interest rates.
Yeah.
We saw a couple slides ago, we saw inflation for the past couple years. Back in 2022, inflation increased dramatically. The Fed raised interest rates dramatically to stymie those, and they started bringing those down, but have now paused interest rates. One thing higher interest rates does create is, it's better for savers. It ups the yields on money markets and cash equivalents. And I
Hmm.
heard one strategist last week refer to the yields on money markets as seductive.
Hmm.
So my,
Yeah.
my question is, do you have any perspective to offer people listening here that might be lured into the current yield and, the perceived safety of cash?
Sure. Yeah, if you look at the next chart, so this is what we call the Fed dot plot. So this is the Fed telling us what they think they're going to do with interest rates. The green is what the market is expecting, and it may be tough to read, but just know that in the past 3 months, this chart has changed quite dramatically. We started the year with the Fed saying they were going to do two additional cuts. The market felt like they were probably done and on pause for a while. Now, with this uncertainty around tariffs, the Fed is also sort of in limbo, waiting, because they have to weigh the potential of slowing growth and potentially a pickup in inflation, um, as to what that means for their decisions. So, they've kind of said we're going to be data dependent, and I think they too are waiting. So, We started the year again thinking that the Fed was largely done cutting rates. They did it 4 times last year, mainly because inflation had been coming down to the target that they wanted, around 3%. But now, there is this risk that, they could be in a real conundrum because if you have slowing growth, that would largely historically mean the Fed would cut to help stimulate. But if you have slowing growth, but also increasing inflation, then you have the Fed maybe actually needing to hike rates to combat inflation rearing its head again. So they're in a little bit of a tough spot right here. So I think what they're doing is prudent, which is waiting and trying to see what's going to happen. So what that means for maybe starting at cash, I think we would argue that cash, yes, with yields where they are, it is quite seductive. But again, within our portfolios, we own a small percentage of cash, but that's mainly for liquidity purposes to be able to buy and sell the stocks and bonds that we're doing in our mutual funds and our ETFs. But if I think about an overall client portfolio, again, if it's money pegged for a liability that's within the next year, cash right now probably is the right place to be. But if this is really meant for, liabilities that are down the road, years down the road, I think despite getting a nice yield right now, I think you will, if history is a guide, you will be missing out on longer term opportunities. And again, if we're higher for longer in the rate environment, I think right now locking in those good rates in core intermediate bonds is a better choice because, if you think about, buying a core bond, a 6-year duration or maturity bond, if it's investment grade corporates or something like that, you're yielding, 5+% yield, which is north in cash, and you're going to earn that for the duration of that bond. Where cash, yeah, it's close to it, but that yield could come down, especially if the Fed does start to cut rates. So again, if it's money set aside for short-term liabilities, fine, and enjoy the nice yield. But if it's money that's really meant for long-term, I think now is a good time to be able to step in and buy the higher yields in fixed income. If you look at the next chart, this looks at all the components of fixed income from the investment grade, safer area to the left to the more extended high yield to the right. And what you're looking at is the gray box represents the 10-year range of yield in that respective fixed income asset class. The blue diamond is what the yield is today. And what it shows you is in almost every part of fixed income, we're near 10-year highs in yields. And, and we want to lock those in. And if in the third environment for cash, if it's really dry powder for long-term growth, we want to take advantage of the volatility that we're having. I'm not saying today is the day to buy stocks, but
Right.
having that dry powder and stepping in, I think is always a positive. Back to that red dot chart from a couple slides ago, it's not just recognizing that pullbacks happen, but if you can invest when those red dots happen, you'll do even better. And I think that's the real, it's Warren Buffett. You invest when you're uncomfortable and you sell when you're comfortable, which is the opposite of what most people do.
Yep. Counterintuitive, but it's sage advice. All right.
Yeah.
So I heard it all depends on what the purpose of your cash is. So thank you.
Yeah. Yeah.
And now kind of opening it up to asset allocation, diversified portfolios,
Hmm.
50, 60 years ago, whatever, Harry Markowitz, he claimed that diversification is the only free lunch in investing. We've all heard that 100 times. We at Argent Bridge certainly preach the merits of diversified portfolios, especially when it comes to not being overexposed to any one thing. And now you see, boom, US stocks that have been destroying everything for so long. They're taking a big breather on the sidelines.
Yeah.
And now we see other asset classes picking up the slack. So I'm just curious, what elements of asset allocation is JPMorgan constructive on right now?
Yeah, it's a great question, and that diversification has been hard to stick with the last few years, if
Yeah.
not longer, right? I mean, we'll get to a chart later in the back, but after 2008, when the Fed, pumped significant money into the markets, it did a number of things. It drove down yields in fixed income. it raised the dollar, so it made, international investing really tough for a U.S. investor. You had the explosion of AI and growth, and so it really was tough to stick with that diversification. But to your point, what's is interesting is everything that people thought that wasn't going to work this year or was going to continue to not work has actually worked, right? In that you've seen, when we say duration, high quality fixed income has actually worked this year when people thought yields would stay high. They've actually come down a bit. And they've delivered that ballast of the portfolio, that negatively correlated asset to equities that we want them to do. And they typically do. So that's an example where, again, we've been happy when people have continued to own high quality taxable and municipal fixed income for that role of yield and diversification. This chart shows you the other thing that surprised people, really going back to Q4 and obviously this year, is value is outperforming growth. And growth is down. You can look on the left. This is again through Tuesday's data, but the Mag 7 is down almost 9% this year. The other 493 stocks in the S&P are up. Now, the overall S&P is down because of how much those 7 names weigh in the index, but it's great to see, and it's something that we thought we were going to see because of the top right, which is for years it was growth the only area where we were seeing positive earnings. And yet now we're seeing in the blue, the other 493, you're seeing their earnings expectations, their profit margins increasing. And I think that's why you're seeing a widening out of the equity market. I don't think I would highlight this is a rotation, not a sell-off. And so all the things that you've owned that have been unloved, like, value, like, core fixed income, we'll get to international in a second. It's great to see them come back in because you're right. There was a lot of market manipulation with all of the QEs that we did since 2008 that really tweaked the markets and made it diversification not work. I think you're starting to see that return to form. The next chart shows you, again, one other thing that we touched on briefly is international. This has been the third rail for a long time. There was a lot of headwinds for developed international and that the dollar was strong. So even if you earn nice returns, your conversion hurt as a U.S. investor. International doesn't have a lot of growth when everyone was just dying for growth. Yes, they were inexpensive relative to the S&P when you looked at their valuation, but there wasn't that catalyst. And I think if you look year to date, Europe is up almost 15% with, like I said earlier on the page before, the S&P down close to 2%. So there's a lot of things, there's a lot of green shoots that have us excited that this is not just a trade, but this is a longer term trend for international to start returning to form. Maybe not necessarily always beating the S&P because it doesn't have that growth potential and those higher earnings, but because you're seeing fiscal spending going on in Europe, you're seeing their rates in the 2% range versus the 4% range. Their stocks give you higher dividends. If one of the things the administration has made it clear they want is a weaker dollar, that'll help U.S. investors. Their earnings are picking up. And one thing too that the administration is trying to get Europe to do is be more self-reliant. And that, you could argue whether that is a good thing or a bad thing, but ultimately that will be a positive for the economies in Europe as they need to become more independent. So there's nothing out there that we would say is sold off so much that it's an easy trade. But I do think there are some things. It's nice to see diversification work. It's nice to see not just one sector or a handful of names drive the markets. And yes, for that cash on the sidelines, being able to step in when you have volatility and things sell off, I think is what you would want to do. So,
Wonderful.
yeah.
Thank you. Before I ask our fifth question, we had a question come in from a viewer, and it's a fairly, I don't know, fairly simple one. Will the layoff in federal employees affect the unemployment numbers at all? Is it big enough to sway things?
That's a good question. I mean, it would obviously impact it. I don't know. Again, we would have to get better clarity as to what percentage and what amount of employees do in fact get laid off or take the package. But I think the short answer is yes. But I don't think it would move the unemployment needle enough for the Fed to do something in the short
Change things.
term, you know.
Yeah.
But again, being in, being from Vienna, you all many of you all are in the DC area where there's a lot of government employees. That is something that has got a lot of people scared. Yeah, I think it would. I don't think it would move the needle dramatically unless they, you really saw them unfortunately go at it with a chainsaw, which, that's unfortunately the analogy they use. I think a scalpel would be better. I think we're all
Yeah.
for removing excess and fraud, but I don't think you're seeing it at the level that they think. Um, and doing it abruptly and quickly without maybe looking through, you've read articles where they took a big swath to the Department of Energy, and then lo and behold, there's 300 people that are responsible for nuclear warheads. I think they're pretty important, and then they were quickly, removed from that layoff potential or that package potential. So I think we would just rather see a little bit more scalpel than,
Less sledgehammer.
yeah,
Right.
yeah,
Right.
yeah,
Thank you.
yeah.
Okay, well, I have one final planned question, and I think it's the most important question. What positives should investors be focused on right now?
Yeah, I think that's a great question, and I think I'm a half glass full person. I think if you look at the history of the markets, they're upward sloping, despite that red dot chart from many slides ago. Despite that 15% drop on average in the equity markets, if you stay invested, the S&P is positive 75% of those years, going back 45 years. So I think that's part of it. But I would start with this chart. Let's look at consumers' confidence in the stock market. And the reason we pulled this up is a lot of people would extrapolate consumer confidence as a good forward indicator, and it's the reverse, right? It's that Buffett analogy, and it's up top in the box there. The average 12-month returns when we've seen a peak in sentiment, when people feel great, it's 3.5% return. And if we look at the 12-month return during the 9 troughs, the lows of sentiment, the market's up 24%. So I think that's one that I'm not saying we're rooting for negative sentiment, but that tends to be a good future indicator that we might be getting to the bottom. So that would be one that's just an interesting chart that many of you probably have not seen. I love the next chart. Hopefully you've seen this from us or others. So this is referred to as the quilt chart. So what you're looking at here, going back to 2010, and we get limited on the size of the chart, but we've done this going back decades. But each color represents a specific asset class. So light blue, for example, is REITs. Orange is small caps. The light green is large cap measured by the S&P. So it has all these different underlying components. And the white box is a thoughtfully 60-40 diversified portfolio, back to what Joe mentioned, that's rebalanced on a regular cadence. And what you see is that white box is never at the top, but it's never at the bottom. And I think if we can take emotion out and realize that there's always something in the markets, in the headlines that has us scared, if we can remove that and just recognize that that's normal. And I look to the far left of this chart, despite all of the things that happened during these 15 plus years, just a very plain vanilla, thoughtfully rebalanced portfolio, annualized over 7% return. And I would take it a step further. The other thing that we could help you with is we have an advisor who takes this chart, prints 100, laminates them, and then takes them to client meetings, and they bring a Sharpie, and they have the client write on top of each of those columns what calamitous event or events happened in those years to remind people. Katrina, the debt downgrade, COVID, there's always something. There's always some headline that has us saying, how in the world could we get out of this? And the reality is we will. And so I think that's another thing. And then the only thing, back to cash, if you look at the far right, the last 2 years, cash delivered 5% and 5.3%. It's the purple near the bottom on the far right, near all-time highs for cash. Yet look at everything above it. right? So I know it can be attractive when yields are there and you don't want to take risk, but sitting in cash, that's the one of the worst things. And if I look to the far left, that annualized 2010 to 2024, the only thing that did worse than cash was commodities. Right. So again, it's just another way to just, try to avoid that allure of cash. And then the next chart is one of my favorites too. And I think this reinforces, and listen, technology is great, but technology gives us access to our portfolios every second of the day. Right.
Yeah.
And before it was monthly statements and now it's daily access. And that's probably the worst thing for us from a financial planning perspective, because it makes us focus on today versus the fact that what you're using Argent Bridge for is saving money, investing money for liabilities that are in most cases decades in the future, college education, retirement, a second home. And so what this chart shows you is going back 75 years now. The green is the S&P, the blue is the aggregate bond index, and the gray is just a 60-40 split between equities and bonds. And it shows you what is the worst 1-year return and best 1-year return for stocks, bonds, and a 60-40. What is the range of rolling 5-year returns, 10-year returns, and 20-year returns? So you can see even a 60-40, the worst 1 year, it was down 20%. Like that's brutal. That was 2022. But again, the money we're investing, you've heard me say this a bunch, is for not a year from now, but for 10 years from now, 20 years from now. So to get the right side of this chart, we need to know that the left side is going to happen. And I would look at the 5-year. There has never been a rolling 5-year period in the last 75 years where a 60-40 portfolio was negative. It's always been positive, as high as 20% annualized over a 5-year period, as low as 1%. And then keep going to the right. Look at the 20-year, look at equities in green, right? This is why we want to own as much equities as possible, but we incorporate things like bonds and other things to help reduce the downward opportunity that happens in equities. But I love this chart because essentially to get the right, which we want, we have to recognize the left's going to happen. And it's going to happen probably when we don't expect it and we didn't predict it, but we just need to remind ourselves that it happens and we'll live through it. And if I stay the course, if I thoughtfully rebalance, if I take advantage of sell-offs, I'm going to do really well. And I'm going to match, my time horizon more in line versus, the short term.
Mhm. Excellent.
Yeah, so I hope those comments were helpful. I know, we don't have all the answers right now, nor does anybody when it
Right.
comes
No one
to
does.
what the administration's thinking, but we're trying to think long term, and within the portfolios that we manage, we're doing what we can to kind of weather it, and then when we get some better clarity, then you'll see, all of us be able to make some decisions.
Yeah, yeah. And Carl, we certainly appreciate this insight is really valuable, and it helps us and especially our viewers focus on the concepts that are important, not the
Great.
specific data points, but the concepts during this period of uncertainty, which, is not fun, but it's normal, like you
Yeah.
said.
Yeah.
So thank you. It's been wonderful having you today, Carl. We
Oh,
really
my
appreciate
pleasure.
it.
Yeah, I
Yep.
hope my comments were helpful. You all are a wonderful group to work with. And for those on the line that use us in the portfolios, thank you for the trust, and hopefully we can continue to deliver the performance in line with expectation.
Yeah. And to all our viewers that tuned in today, thank you very much. Feel free to reach out to any of us at Argent Bridge with any follow-up questions that you have. And be sure to check out our monthly Cup of Joe video series that's on our YouTube channel. So again, thank you everyone, and have a wonderful day. Bye-bye.
Hey, everybody.